October is a scary month for most investors in the United States and across the world. Many investors believe that October comes with falling stock prices and terrifying investment returns. As such, they call it the October effect. The October effect is a recognized market assumption that the value of stocks will reduce during October. In the history of the stock market, many big declines in market took place in this very month, and this may shake the interest of many investors for this month. But beyond serving as a brief history lesson, is there any real logic or merit behind October's place as the most feared month in the financial calendar? Join us in this episode as we take a closer look at the issue of October effect. What the statistics say. The performance of S&P in the last 92 years show that October isn't a bad month for the stock market at all. Statistically, the number of times the S&P 500 has gained in October is more than its losses during the last 92 years. So, if October isn't the worst month, what is? October's next-door neighbor, September, is actually statistically the worst month for investors. September is statistically the worst month since investors lose approximately 1% during this month. History shows that September can be difficult for stocks. Since 1950, it's been the most critical month for the S&P 500, which declined at an average of 0.5%. Why September is the worst performing month for investors? Experts say these three key factors should make investors wary of September. Profit taking. Historically, the stock market usually declined in September due to seasonal behavior changes on investors. Many investors change their portfolios as summer ends to cash in. Tax loss harvesting. Another reason why September is the worst performing month for investors is tax loss harvesting. Tax loss harvesting is a strategy in which certain investment assets are sold at a loss in order to reduce tax liability at the end of the year. Investors use tax loss harvesting to offset capital gains that result from selling securities at a profit. Investor vacations. Many investors go on vacation during the summer months and overall trading volume is low. When investors return from vacations, they're then selling off positions they plan to sell. The influx of trades as summer winds down would lead to increased selling pressure and an overall decline. This trend is another possible explanation for the market's poor performance during September. So why do investors fear October instead? The October effect myth has become so deeply ingrained in the minds of investors because October happens to be the month where the most painful declines in stock market history occurred. For example, the Great Crash on October the 29th, 1929, also known as Black Tuesday, ushered in the Great Depression. In 1987, the Dow Jones Industrial Average plunged more than 20% during Black Monday on October the 19th. It was the index's biggest one-day percentage loss in history. And more recently, October 2008 was a brutal month during the financial crisis as the Dow dropped about 14%. Events that led to the October effect myth. The October effect myth was caused by two major events. Both events occurred in October 1929 and 1987. Let's take a look at these events. Black Tuesday, October the 29th, 1929. On October the 29th, 1929, Black Tuesday hit Wall Street as investors traded some 16 million shares on the New York Stock Exchange in a single day. Billions of dollars were lost, wiping out thousands of investors. In the aftermath of Black Tuesday, America and the rest of the industrialized world spiraled downward into the Great Depression, 1929 to 1939, the deepest and longest-lasting economic downturn in the history of the Western industrialized world up to that time. What caused the 1929 stock market crash? During the 1920s, the US stock market underwent rapid expansion, reaching its peak in August 1929 after a period of wild speculation during the Roaring '20s. By then, production had already declined and unemployment had risen, leaving stocks in great excess of their real value. Among the other causes of the stock market crash of 1929 were low wages, the proliferation of debt, a struggling agricultural sector, and an excess of large bank loans that could not be liquidated. After October 29, 1929, stock prices had nowhere to go but up, so there was considerable recovery during succeeding weeks. Overall, however, prices continued to drop as the United States slumped into the Great Depression, and by 1932, stocks were worth only about 20% of their value in the summer of 1929. Black Monday, October 19, 1987. On this day, stock markets around the world crashed, though the event didn't happen all at once. Black Monday saw the biggest one-day percentage drop in US stock market history. The Dow Jones Industrial Average, DJIA, dropped by slightly more than 22%. The S&P 500 index suffered a similar decline of 20.4%. To give you some perspective on the severity of Black Monday, the worst one-day drop in the DJIA during the stock market crash of 1929 was just over 12%. In other words, barely more than half of the decline that occurred on Black Monday in 1987. How did it happen? Some imminent warning signs for investors were evident in the trading days just prior to what would turn out to be the Black Monday. On October the 14th, the Dow experienced a major decline of nearly 4%. It dropped another 2.5% the following day. And the day after that, October 16th, the Friday before Black Monday, saw a devastating 5% loss in London stock markets that, ominously, coincided with the Great Storm of 1987, an unprecedented severe weather phenomenon that produced hurricane-force winds in the English Channel and resulted in nearly 24 fatalities. On Monday morning, the crash started in Hong Kong. The crash continued throughout all of Asia and all during the Asian trading session, as other markets began to feel the aftershocks of the initial crash. The market carnage continued, spreading throughout Europe when the London market session opened. By the time the US stock markets opened, stocks were virtually in free fall. By the end of the day, the DJIA had dropped by more than 500 points and the S&P 500 by more than 55 points. Black Monday was such a painful day for investors that it further solidified the notion that October is a bad month for the stock market. What are the best months to invest? A question that many investors face is when to invest. Are there certain calendar months that are advantageous and others that should be avoided? Experts advise that the average return in October is positive historically, despite the record drops of 19.7% and 21.5% in 1929 and 1987. The so-called January effect argues for buying in December. The Santa Claus rally argues for buying in November. As for selling, some say sell in May and go away. Others believe that August and September are the worst months for stocks. Historically, in terms of average returns, January, April and December are the best months to invest. Here are what these months represent among majority of investors. January. Being the start of a new financial year, January has a big implication for the stock market. In January, most companies in the United States tend to announce new innovations and products that would attract investors. With this in mind, investors buy more stocks in January than any other month. April. The month of April is also a great month for you to invest. In the United States, April 15th is generally known as Tax Day. While most consumers file for refunds, a majority of them are already thinking of ways to spend the refunds, including investing in the stock market. As such, it creates an influx of investors coming into the stock market. December. December is the last month of the year where most religious holidays take place, which leads to increased spending. Consumers spend money on virtually everything, from gifts, travel to food items. Publicly traded companies experience increased sales of their products, leading to revenue growth. Also, investors are more likely to expand their portfolio this month. With this in mind, the next time someone tells you October is a horrible month to invest, instead of getting scared, take time to do thorough research of the stocks you're interested in before making a move. That's it for this episode. If you found the information here useful, hit that like button. And if you want to support us even more, buy us a coffee from the link in the description. If you like to see more episodes on financial advice, hit that subscribe button and turn on the notifications for our latest updates. Good luck and see you in the next episode.